I was 25 years old when I got my very first credit card. I remember walking out of the bank thinking I made it to the big leagues. I was going to all of the shops, telling the cashier, let me put that on my card. Thank you. Oh, $285. I'll use my card for that. Thanks. I was swiping up a storm until the storm was over. And in the aftermath, I was left with a ton of debt. Today on Money Sense with Sheandra, we're going to be talking about credit cards and how to properly manage them. First, let's talk about the difference between the money on a debit card and the money on a credit card. The money on your debit card is your money. It came from your salary, your businesses, your investments. It's money you've generated that was deposited into an account attached to the debit card. The money on your credit card is not your money. It is the card issuer's money. So, for example, if you got your credit card from a bank, it's the bank's money. It's a set amount of money the bank has agreed to continue lending you as long as you pay it back. That set amount is called your credit limit. For those of you preparing to apply for a credit card, something I've learned from experience is that just because you qualify for a high credit limit doesn't mean you should accept a high credit limit. Go with a limit you know you can manage, especially if you struggle with financial discipline. Banks in particular thrive on building relationships with their customers, but don't get it twisted. They are not the home girl or home boy you can go to and say, let me hold a 20 and pay them back later than promised, or not at all, without consequences. Consequences include late fees and the biggest fee of them all, interest. Interest is the extra money the bank charges you for borrowing their money. It's a percentage of the amount you owe the bank. It's calculated over time. So the longer you take to pay the bank back what you've borrowed, the more interest you're charged. Every month, the bank will issue you a credit card statement. The statement outlines the money you've spent and the money you owe for that billing cycle. Your statement balance is the most important balance that you need to pay attention to when managing your credit card. You can find this balance on your credit card statement. Your statement balance is the amount you owe for that billing cycle, the amount you've borrowed and haven't paid back. Most consumer bank issued credit cards have a grace period that allows you to borrow money interest free as long as you pay the statement balance in full by the payment due date. The payment due date will be listed on your credit card statement and is typically 21 to 25 days after the statement date. Now, let's talk about credit card minimum payments. This is what trips a lot of us up. I know it tripped me up when I got my first card. The minimum payment is the minimum amount you need to pay to remain in good standing with the bank. It's usually a small percentage of what you owe or a flat fee that's minimal compared to your credit limit. This could be as low as $35 to $40 a month. Remember, to avoid being charged interest, you must pay the full statement balance by the payment due date. If you only pay the minimum payment amount by the due date, you will incur interest fees. Over time, interest can cost you hundreds and potentially thousands of dollars for borrowing the money you've spent. Another balance that's important to pay attention to when managing your credit card is your current balance and your available balance. Your current balance is everything you owe on your credit card as of today. This includes your statement balance, any purchases made after the billing cycle, minus any payments you've made. Your available balance is how much credit you have left to use on the card. Paying attention to your current and available balance helps you prevent maxing out your card or going over the limit, which some credit cards allow. It also helps you control your spending. Remember, the money on your credit card is not yours. Every swipe you make, you are borrowing money from the bank and incurring debt. Not every purchase you make should be made with a credit card. There are two key instances where, to me, using a credit card makes financial sense. First, you have the cash, but there's a strategic benefit to using your credit card. Some cards offer cashback rewards, airline points, and other benefits. In this case, you use the card, get the reward, and pay it off right away with money you already have in your account. You were technically in debt, but only for a day. The second instance is when you don't have the cash, but will be able to pay back what you spend by the payment due date. Instead of asking a family member or friend to borrow $500 until you get paid, or instead of dipping into your emergency fund or money that you have set aside for something else, you can borrow it from the bank by using funds from your available credit card balance. To do this responsibly, make sure, one, the income you plan to use to pay back the bank is guaranteed. Two, the income will arrive well before the payment due date. And three, paying your statement balance won't affect your ability to cover other monthly expenses. If the money left after paying your statement balance isn't enough to pay your monthly expenses, then you should not be using the credit card. A general rule of thumb when it comes to credit cards is to keep your balance below 30% of your credit limit. Emergencies come up, and keeping a low balance reduces the chance of maxing out your card or going over the limit. Staying under 30% also signals discipline to the bank. For example, if you have a $10,000 credit limit and a balance that's under $3,000, that's a good indicator that you may be trusted with a credit increase or even an auto or home loan. After all of the credit card debt I incurred, I became afraid of credit cards. But credit cards become less scary once you learn how to manage them.